Well, good morning. How's everybody doing? Give me just a second. I'm getting things arranged here. Good. Obviously, you can hear me. Hello, Brenda. Hello, Helen. Hello, Kevin. Morning, Tom, or afternoon, wherever you're at. Alex. Everybody's out for fun today, huh? Deb! Long time. Good to see you. Even Roman made it. Cool. Good to see y'all. Back to the rain, huh? Uh, just hedging a little bit for a second. I was a minute or so late, but let me see if the camera's working properly today. It is kind of. I think that's backwards though, huh? Oh well. I don't know how it's supposed to work. I'm only like a quarter of a nerd, so. But welcome out to Trading Coach's Playbook. Let's get the disclaimer out of the way. I am not a registered broker-dealer investment advisor. I'm not going to give you any recommendations or advice. Everything we do here is purely for educational purposes. If I do happen to mention a trade, just assume it is a paper trade or practice trade for regulatory reasons. We do not discuss funded trading. So the good quarter. I guess that's a good way of putting it. I never thought about it like that. But here's all the upcoming stuff that we have going. Inner Circle is March 23rd, Mastermind the 24th. Well, and the you see their dates there too. The Trading You, Inner Circle, and then Cover Call Explorer with Trip, April 22nd. And then the Power Option plays every Thursday or Tuesday and Friday, and then Cover Call Explorer with Trip on Thursday. The free workshops, Power Hour every Monday. Trading Coaches Playbook, this one is every Friday. The Clockwork Income Formula, March 24th and 25th. And then E-Mini Think Tank with Brandon Monday, Wednesday, and Thursdays. So I'm a little wiped out. The last 3 nights, my brother and nephew have been staying with me. So we've been up chatting a little bit. It's not very common. He was getting his hardwoods redone. So the lacquer or whatever they're putting on it apparently was not very good to breathe in. He went over there yesterday and he's like, "Oh my gosh, I could smell it from outside the garage." So, but they're going home tonight. It's supposed to be better. He's over there opening his windows and stuff right now. But he works from home most of the part, so he's just sitting in my living room or in my dining room and working from my table. But it's been fun. His wife and daughter stayed at her mom's house, so but don't get to hang out with my brother that much. So it's been kind of cool having him here for a few days. So no wild parties. We're too old for that, Brenda. Way too old. And his son's still too young. He's only 13. Couple more years, he might, 2 or 3 more years, he might be end up like his father and start partying when he was 15 and 16. But we won't go there. That'll opens the can of worms. And well, at least my brother's not here, so we won't hear the stories. But anyway, uh, if we haven't met, um, there's a few tools that I've created over the years. Or well, small accounts, big returns is a 2 hour class that was pre-recorded. Just if you're working with a smaller account, just some different techniques and strategies you can employ to grow it to a bigger account because that's the ultimate goal, right? And then you get patterns of flash, weekly whispers, or other tools that I have that you can grab a trial to if you haven't experienced them yet. So, but let's get to what we're talking about today. Make sure this isn't my brother. Actually, I'm such in the habit of doing the nope. Um, we're talking about risk management and position sizing, and some of this will be probably review for you. So, if it's too elementary, bear with me. But that's the thing. I know some of you have been around for a long time, and the interesting thing is there's little nuggets, or sometimes somebody says something a different way that just triggers a thought, and you're like, oh, um, it's a little bit different, right? And that's the edge is what we're looking for here, and that's what we need as a trader is that little bit of an edge. So That is a good question, Alex. I don't know. I don't normally go and look at the site to see what's there, but that's a good question for the support team. I thought it was on there, but then again, like I said, I'm not going and looking. So I'll have to ask and see. But I don't know I think it's Alyssa today. If we could check on that, that'd be nice. Find out if it accidentally came down or I don't know. I'm not sure. The support team is awesome and the tech team is awesome. So I don't deal with any of that stuff on the back end. So as I said, I'm not a nerd. So let them deal with it. I try to stay in my lane, and I complain about other people not knowing how to stay in their lane. So I gotta stay focused and humble myself to make sure I'm in my lane and not jumping into somebody else's. So oh, the weekly whispers. Alex said it's not on the site. I guess I don't know. Maybe it's in a different spot. That's a good question. Okay, thanks, Alyssa. I think is it, I hope I'm pronouncing that right. Um, yeah, I'm not sure honestly, but we'll see. Um, so why risk is first? This is one thing I've said, and I recently because I go and listen to other people. I listen to Rob now and then, and Brandon and Tripp, and because it's good getting different perspectives and different people's points of view. And I was listening to Rob, I don't know, a few weeks ago, I guess, and he was talking about risk and not focusing on risk, and which I know the perspective he was coming from was don't see it as a negative thing. Don't frame it in your mind as a negative thing. And I've been, especially lately, I've been just pounding on risk. Like, and when I first heard it, I'm like, wait a minute, what are you talking about? Risk is like the most important thing to focus on. But then I realized he's talking about it from a perspective of not focusing on the fact that you might lose. It's a positive mindset type of thing is what he is his perspective. Mine is also a positive mindset in the sense that if you don't focus on risk and you blow up your account, then that's kind of a problem, right? So it's how you frame the risk inside your mind that makes it important. And the reason that I'm so focused heavily on it because, like the first question there is, what's the only thing we have almost total control of trade? The risk, right? You don't have any control of how the outcome's going to be. You don't know how if the stock's going to move big, if it's going to move small. You don't know what it's going to do. It might just chop sideways and eat your time value up. But the one thing we do know, the one thing we do have most control over is the risk. I mean, obviously, if something gaps against us with news that was unexpected, that's outside of our control. That's why I put almost there in caps because we don't have 100% control. Now, if it's an earnings announcement or something like that, and you know it's coming, then you have control over that. But I had one recently where news came out and it wasn't expected. Nobody knew it was coming out except the insiders, obviously. And you get blindsided, and it happens. But it doesn't happen very often. You might have something like that once a year, once every 2 or 3 years. It's just not very common. So the only thing we have pretty much total control over is the risk. So it doesn't make sense in my world to focus on the outcome of what I might make or what I could make if it moves in my favor because I don't know what it's going to do. Obviously, we analyze the chart, we look at it, we think it's going to go this way or that way, and it looks like it's going to do that, and all the odds are it's going to do that, and all the evidence points to the fact that it's going to move this direction. But none of us have a crystal ball. So, but the key is to create a risk framework, well, just a trading framework in general, not necessarily just risk, but a trading framework in general. Because having a plan is, as you all know, trading is exceptionally emotional. It's probably one of the most emotional things you'll do. And the question becomes, how do you protect yourself from the fear and greed side of it, which will you will wrestle with every single day. I do every single day. Everybody does. I don't care who you are, and I don't care what you do. I mean, as most of you know, I refer to sports a lot, and I mean, the difference between the amateurs, those that make it pro and those that don't, is mindset. Is they learn to manage and control the fear and the greed and the the emotional side of the game. Because if it was just purely about physical athletics, then one of my best friends and another guy that I went to school with would have both gone pro easily. And Another guy wouldn't have gone pro because he wasn't as physically talented, but he did because he fought through the constant disappointment of being in the minors, right? He got into the minors drafted right out of college, I believe. And then it was 4 or 5 or 6 years before he got called up. But he finally got called up and played for Anaheim for a couple of weeks. And I think that was enough of a taste to be like, "Ooh, I'm going to keep chasing this dream." And he did. And in '05, halfway through the season, he was with the White Sox club team in the minors, and their catcher, the primary catcher, first stringer, whatever they call it in baseball, I don't remember. He got hurt, like season-ending injury. So Jamie got called up, and he played for them the rest of the season as the backup catcher. He played every Sunday, basically, to give the other catcher a break. And and then it was, I think, 3 years later when he officially made the team, where he suited up on opening day because he'd been in the minors for 13 years or something like that. Crazy amount of time. Most people quit after that. Most people quit after 3 or 4 years, and they don't keep going. Well, he did. He wanted it bad enough, and he was willing to fight through that constant disappointment every year, like thinking he was going to make the team. I remember asking him in '05. I went up to Chicago and was like, "Are you going to play next year? Are you going to keep going?" He goes, "Yeah." He goes, "I was thinking about packing it in this year, but he goes, it's too much fun now." He goes, "I got to keep going and try at least." And it still took him even the next year. He didn't make it, and I was curious, just like, and he kept saying every year, "Now, one more year," and then he finally got there, and he played for the Mariners for a couple of seasons, full seasons. But then next year he got, I don't know if he got cut or I don't remember what the deal was, but these other two guys were far more physically talented. But Jamie fought through the disappointment and the fear and the greed and the hard part, the emotional part of the game of, and he just never gave up. And in my world, if you want to succeed in trading, the only way you fail in trading is to quit. Because if you keep going, you keep fighting it, you keep fighting through the hard parts, it's a roller coaster ride. And you're going to have good days, and good weeks and bad weeks, and good months, bad months, good years, and bad years. It's just the nature of the beast. And if you keep tweaking it and honing your skill and finding the edge, then you'll get there eventually, just like Burke did. So, but position sizing makes risk management practical and repeatable, right? And when we say position sizing, what just happened? Oh, I was like, wait a minute, that's the same thing. And the reason I call it risk reward, and some people have flipped it over and called it a reward to risk, which is fine. I don't care how you say it. I'm not into the whole semantics thing. I'm not a word policeman. Um, the key is, like I say, that the main thing, if you will spend most of your energy focusing on managing your mindset, managing your emotions, the rest of it will fall into place. The rest of it really doesn't matter that much. How you say it or how you frame it, or and I love Ryan to death, but I remember years ago, and I'll never forget. I don't know why I was driving on White Road over by a house we lived in at the time, and I was working on my mind and trying to go from, instead of calling it a loss, call it a cost. It's a cost of doing business, right? It's like any business. If you buy a product, wholesale a product, you put it on your shelves and nobody buys it, you got to drop the price down to get it off the shelves. You want to get your capital back, right? You don't want to lose money, but sometimes you have to lose money, right? You bought a widget for $10, you try to sell it for 20, but nobody's buying it. So you mark it down 50% off. It's $10. You want to break even, just get your initial capital back, but nobody's buying it there. So you drop it to five, and you take your loss and move on. It's a cost of doing business. Every business deals with it. But then it dawned on me one day, I'm like, you know, does it really matter what I call it? Does it matter if I call it a cost or a loss? Because there's still a hole in my account, no matter how you slice it, no matter what word you attach to it, there's still money missing. So, and I'm not opposed to it. Whoops. I'm not opposed to changing your language to shift your mindset, but just changing the language isn't enough. If that helps you change your mindset, great. But the main thing is to focus on changing your mindset to where taking a loss is no big deal because you know it's part of the business. So again, to me, it doesn't matter what you call it. It's a question of how do you frame it in your mind? How do you think of it inside your head? And I call it a loss all day long because the loss doesn't bother me anymore because I know it's part of the business. It's just I've got it ingrained in my mind now. So the words don't mean anything anymore. It's the concept and the emotions that allow it to have. But you'll notice that the first question on this is the same as the last slide. Mainly just to reiterate, like, hey, the most important thing is making sure you control your risk. Define your stop, target, and entry before you even place the trade. You should always have that in there. And I put that in that order for a reason. Your stop should be first, your target second, your entry should be third, based on math. And if, now let me qualify this, and I should have written this on there. The 3-to-1 risk reward refers to directional trading, right? If you're buying calls or puts, or even if you're buying stock. Now, that might be a little bit different with stocks because just because of the nature of them. But if you're trading a leveraged instrument, especially like options are a form of leverage, right? If you're trading something leveraged, futures or commodities, futures, options, they're all a form of leverage, right? You should have at least a 3-to-1. The higher the leverage of the instrument, the higher the risk reward should be. You can't go too high. You got to find the balance, right? You can't do like a 30-to-1 because you're going to get stopped out constantly. It's got to be enough room for it to wiggle there, right? But for the most part, I'm trading a 3-to-1 risk reward. And I'm trading mostly options. I do a little bit of futures here and there. I'm playing with it, but they're highly leveraged and they move fast. So it gets wild and crazy sometimes. But I think the main thing to focus on is changing your thinking and framing your trading mindset into where you're thinking about risk. How much risk do I have in the trade? And we'll get to the most important question here in a minute. But position sizing determines how big the trade should be relative to your account size and risk. My baseline rule is 10% maximum, right? And that is going to vary depending on the size of the account you have. If you've got a $1,000 account, you're only putting $100 into a trade. That's a little tight. I mean, you can do it. You can find trades, and if you have the discipline to do that, you will most likely succeed long term because it's hard to find a trade for just a buck. Um, Thank you, Alyssa. Appreciate that. Um, it's on my screen. So if you have a smaller account, you might need to bump it up past 10%, and you're gonna have to gauge that. But if you got, say, a $10,000 account, 10% is $1,000 a trade. That's feasible, right? And that's reasonable. If you got $1 million account, 10%, if you're putting it into a leveraged position. If you're buying a stock, it's not that, $1 million account buying $100,000 of a stock that you plan to hold for a period of time, or maybe you're going to write covered calls on it or something like that. If you're doing some other strategy, that's not that big of a deal. But if you got $1 million account and you're trading $100,000 on one optional position on a highly leveraged position like that, that in my world's a little bit cray cray, right? As the kids say apparently now, cray cray. Or maybe it's changed from that. I don't know. It changes so fast anymore. I can't keep up. I was talking to my nephew a little bit. We've been working out the last couple of days, asking him what are the cool words now. It's like okay, it's interesting. But the generally speaking, the maximum is that I will put into a trade is 10%. And I don't very often even do that. And the bigger your account gets, the smaller that percentage number should get, especially when you're talking about leverage positions. But the key is the second bullet point there is the purpose is to standardize exposure and prevent one trade from destroying your account. Because if you put half of your trade into an account, if you got a $50,000 account, you put 25 grand into one trade, yeah, you might kill it. I mean, if you get a double on it, you just increase your account by 50%. But if news comes out and whacks you on that one and you lose 20,000 of it or the whole thing, you just knocked your account in half. Let's just say the whole thing goes away. And here's the interesting part that a lot of people skip over that sometimes we don't even think about. If you have a $50,000 account and it gets cut in half, how much do you have to make percentage wise to get back to break even? You got to double it, right? You got to make 100%. You lose 50%, you got to make 100% to get it back. Exactly, Alex. That's what it takes. That's why if you take a big loss, it's a lot harder to overcome it and make it back. But if you only do, say, you get a $50,000 account and you put $5,000 into a trade or less, and news comes out and it goes bye bye, then that's $5,000. That's only 10% of the account. That you can make up with in another trade. I'm not going to say easy, but I mean it's certainly not 100%. You only got to make, well, see, if you're 40, you only have to make 11 or 12%, right? Because if you have 50,000, you lose five, you're at 45. You make 11 or 12% on that, you're back at break even. You don't have to make 100% to make it back. It's a good point, Alex. He says at that point you may as well just put it all on red. If you're gonna bet half the house, you might just bet the whole house, right? That's called gambling, and we are trading. At least that's the goal. But I do gamble sometimes, not necessarily intentionally. It's very rare, but sometimes I do just knowing it's a gamble too. It's like, okay, I'm gonna, you know what? I know this is a crazy gamble, but I'm gonna throw a couple hundred or 500, 1,000 bucks at it. Just do something small and be like, all right, let's just swing at this. Occasionally it's fun to do that, right? I mean, everybody goes to Vegas now and then. You put it all on black. You take, you got a couple $100 or whatever, or 1,000 bucks, whatever you're playing with. Let's see if we can double it. So I'm not opposed to it. I mean, as long as you know what you're doing, as long as you understand that, the whole thing could go bye bye in one fell swoop, right? But the key is that the bottom point, and this is kind of the overarching point of today is talking about this, is it helps traders survive long enough for the edge and discipline to matter. Because in trading, what you need to survive long term in the market, you need an edge, and you got to have excruciatingly good discipline. That's one that I've struggled with for years, is the discipline side. The edge I kind of have, if you're familiar with patterns and you know how to recognize patterns, and you can see the patterns in the charts and the sentiment shifting, and who's winning the battle, bulls and bears. Once you can analyze that and you can see that, then you have an edge. And having the discipline to stick to that edge and stick to your plan is the key, which I've gotten good at. It's took me a long time to get there. But the key is capital preservation. That's another way to put that. Because if you blow up your account, then what do you do at that point? You got nothing to trade with, right? I mean, if it's all your trading capital. I mean, if you have a backup, if you're new to trading, I usually suggest that. If you have a $50,000 starting account and you're new to the business, then take 5,000 of it and use it to trade and apply the 10% rule. Leave the other 45 there because the odds are at some point you're going to blow up an account. I've done it twice. I don't think three times. I think twice. And I don't know any trader that hasn't either blown up account or blown a serious hole. I only know one trader that blew a serious hole in their account. Every other trader I know has at least blown up an account at one point or another. And if you read books about the best of the best traders, that in history that have been around, they've all blown up accounts at one point or another. So your goal should be to not blow up the account, right? Or if you do blow up the account, have enough backup there that you can take that learning experience and apply it and do that again. So if you had say 50 grand, just use 5,000 to start. If you're new, right? And get some experience, get your feet wet. Make sure you understand what you're doing. I can't tell you how many times being in the seminar business since 2000 and traveling around the country and seeing people and they just get nuts because they see how much money they can make, like woo, and they see other people making a ton of money and they want to do the same thing. So they make wild and crazy gambles, not a trade, it's a gamble. And if it pays off, I mean, the best example I have back in, gosh, what was it, 2001? Maybe it was 2007 or 2008. No, it was 2001 because it was the dot-com bubble that got this guy. He went to one workshop, learned options, learned how to trade, and he was copying the traders in there because, set up an account before you show up. And this is back in the day before internet trading and everything. It was just barely starting out. But this guy sets up a $2,000 account. That's what he had to trade with. And he's in the workshop, and whoever the instructor was buying Qualcomm. Qualcomm was the darling of the day, just like Nvidia's been over the last few days or years, a couple, 3 years. Except Qualcomm went absolutely berserk. It went from, and he broke every rule that he learned. He sat there in class, learned, you buy a Delta that's, 70 to 80 or 70 to 90 or something like that. Um, make sure there's plenty of, which there was plenty of open interest on Qualcomm, but he broke all the rules. He went and bought a short term, out of the money call option. The stock was around 200 or something. And I think he bought like the 300s. And he wanted to be a big shot and trade with the guy. He put his whole account, that whole $2,000, he bought like 15 contracts. I think he said 15 or 20 or something like that. Just an absolute 100% gamble because there was only like 2 months of time. And guess what? The Powerball ticket hit. In 6 weeks, that little $2,000 turned into over $500,000 because Qualcomm went from 200 up to, it ran, zoomed to $800. You go back and look at the chart. It was early 2000, I think it was. It was around 200 or 250, and it ran all the way to 800. And that little $2,000 account he had in 6 weeks was over $500,000. And that's about what that is. That's about the equivalent of a Powerball ticket hitting, as far as the odds of something like that happening. It was just crazy. And he's telling me about it. And he just kept doing the same thing. He didn't go back to another workshop. He went one time, and in 6 weeks, he had over $500,000, and he just kept doing the same thing. And in 6 months, he took it up to like 1.2, 1.3 million. He quit his job. He was a trader for life. Paid off his house. He rehabbed an old classic car with his son. But 2 years later, he was back there, and he was back, and he was begging to be able to go to. He wanted to go to a technical analysis workshop, and he wanted to go for free because he was broke. He paid off his house. That was about the only smart thing he had. But he was trying to sell that because he also didn't made the massive mistake of not setting any money aside for Uncle Sam. And in that 1 year, he had like over $1 million in capital gains, and he owed 150 or $250,000 in taxes. And he lost all of it when the market crashed. He gave all of his. He kept doing what he was doing. Didn't know how to chart. Didn't know what was coming. Nothing. Had no clue what he was doing. I mean, I felt bad for the guy, but at the same time, it was like, no, a little humility goes a long ways, especially in this business. Because as I've said many times, if you don't humble yourself, the market will humble you real quick. The point of the story is that the goal is to preserve your capital. Because if you want a story like that, it's probably not going to end fun. But the goal should be to gradually, not necessarily slowly, but to grow your account steadily. Because if you take over leveraged, oversized positions, and you're right, and you're on the right side of it, you can make a lot of money really fast. But you can give it back really fast. And I know there's some of you in here that have experienced that. You take 5 grand, turn it into 50, or 50 into 300, but then 3 months later, you've given it all back. And if that's what you have experienced or you are experiencing, it's probably because you're taking too big a risk and you're not position sizing well. You're probably not scaling either. And the question is, do you want those wild swings, or do you want more of a steady, consistent growth? How much are you willing to risk on a trade, right? And then again, talking about risk and position sizing. This is just a simple model. How much are you willing to risk? And like I said, my baseline max number is 10%. But again, that's max, and it should go down with the size of your account. And I can't tell you where. I mean, even if you have $1 million account, you want to put $100,000 into an option trade. I'm not necessarily opposed to it as long as you know what you're doing. It's not a huge one. If you got a really spectacular setup, as long as you manage it well, you can handle it emotionally. Where's your stop, right? How volatile is the instrument? If it's a super volatile stock, How large should the position be? But before you pull the trigger, and this should go for every single trade, no matter what, is are you comfortable with the risk you're taking in the trade? If you can look at it and say, okay, I've got 500 bucks of risk, or I got $2,000 of risk, or $5,000 of risk, am I comfortable with that? Can I stay in a calm, cool, collected mindset while I'm in this trade, knowing that I could lose that much if it doesn't gap against me? With that back in the mindset that it could move really fast, it could gap against you, or it could move really fast against you, and then you're in a world of hurt, right? So the question is, are you comfortable with the risk? And if you can't answer that yes, you shouldn't be in the trade. Or you should adjust the size to make it where you can answer that question yes. You should always be answering that question yes. ATR, here's just a this is just to add a little idea if you want to use it. I don't really use ATR, but I know some people do. It's average true range, right? It helps estimate the normal trading range of a stock. And some people will set a stop based on the ATR. It's some, and this is a rule again. I don't use it, but I wanted to put it in here just because it's something that some people like to use. Uh, yeah, risk factor of 20 basis points. Again, that's just a generic rule that some traders use. You can adjust it for whatever style of trading you're doing. Other position sizing models that some people use, fixed ratio. Some people use a percentage as a stop. Like I'm willing to risk 5% in this trade, or 2%, or 1%, whatever the number is. And then risk parity. This is something that some people do. If you're building out a portfolio, if you will, or if you have maybe a bunch of positions and you want to keep the risk equal on positions, then you'll look at the volatility of an asset, right? Take a stock like a Tesla that has a beta of maybe three. I'm not sure what it is, but uh, if it's got a beta of three, then you might want to find a stock that has a beta of 0.33. They even each other out, right? And then you'll put maybe 100 contracts of the 0.33 beta and only 10 contracts of the 3 beta stock. So in other words, you take the more volatile stocks and you put a smaller position in it, and you put a bigger position in the less volatile stocks. So risk wise, you have about the same amount of risk per trade. But again, it's not something I really I do it a little bit, but it's more of just kind of a look and feel. Like I don't trade most of the big, really super volatile stocks. I don't usually trade them. If I do, I don't take a big position at all. If it's a low volatility stock, I'll take a bigger position. I just got out of my last little bit of Warehouser, which I'm cranky at now because it's moving back down. But I took a bigger position in that because it was a $24 stock, and the options were two and a quarter or something like that. They weren't expensive and it was low volatility, so I take a bigger position in that because it doesn't move as fast. It's not freaking me out. And if you do get freaked out by big moves, then go trade stocks like Warehouser. I still ended up banking like 25, 30% in a couple of weeks, 3 weeks. Of course, I got out of the last little bit 4 days ago, and now it's back down a bunch. And it would have been almost hit my target, but it's all right. It wasn't a big position left anyway. So, um, woulda, shoulda, coulda, right? That's the biggest, that's the hardest mindset thing to get over, right? It's always there. You got to fight it every day. But scaling is a phenomenal tool. Most of you have probably heard me talk about it quite a bit. Um, Mainly because if you want to maintain your emotional stability, scaling is a massive, it is a tool that will give you massive results. And it just boggles my mind especially just in the last year or two, where I've really started to do it a ton more than I used to. I used to do it just a little bit, but then I started to see the benefit of it. And the more I employ it, the, I guess the more stable I would say my mindset is. I'm not, I very rarely even just freak out and panic anymore. It's like, okay, I get up, the more the future's this way, the future's that way. It's like, okay, I'm not worried about it. My risk is under control. I don't have too much in any one position. I am heavily loaded up on one side, not quite as much now. I've scaled it out, which is why I do that, right? Because I will sometimes, if it looks like we're going to get a big move, I will load up heavier than normal. but then I scale it out so that I get back to a normal risk management so I don't have too much on one side. I mean, I'm mostly bearish, right? So if you get too heavily loaded up on one side of the market and things move, they move in your favor, you're stoked, right? But if it moves against you, and I've been on both sides of that coin. I mean, the last 3 weeks has been spectacular. The couple months before that was like, it was just kind of chopped, but it was like, this was no fun. Um, but then when it does move, but if it moves against you, which I've had that happen, getting super heavy loaded up on one side and news comes out and it bolts, which is one of the reasons, especially right now, I'm working on scaling out of my positions because the potential for news, with a war going on and things happening and a lot of volatility in the markets, things can swing back. And especially when we start selling off like this, like we have, there's going to be a short covering rally at some point. And there's going to be the buy the dippers that come in and snap up like, hey, we've dropped 10% or whatever the number is. They're waiting. The buy the dippers, the bulls are waiting for a big enough retracement to justify coming back into the market. So once we get to that point and they step back in and the short covers come in and go, hey, you know what? I've got a 10 or 20 or 30% profit on this thing. I'm going to bank my profits. So you get buyers and short covers, which are buying, right? So you get double whammy. So when we turn bearish and we sell off like we do, the volatility to the upside can be very big. You can get massive whipsaws. And part of the reason I like to scale is because as it's falling, I'm trying to max out gains without leaving the risk for the bounce too big because the bounce will be probably very big. Hence the reason just before we started, we're at a pretty significant support on the SPX. And I am fairly heavy on the bearish side of things. And I think we could bounce right here. The shorts could come in and cover. They may not. But I just took a small position just to hedge against. So if it does bounce here, I just bought some spider calls. Like if it does bounce here big, then I've got some protection against that. If it continues to fall, awesome. My bearish positions will continue to gain. But if it does bounce, I can hang on to those now. Now I can hang on to those bearish positions without fear of a massive wild swing to the upside. I just bought a weekly option for next Friday. I'm like, okay, it's going to cover me for the next week. It was, I think I got filled at 82 cents or something like that. It wasn't even expensive. But I'm like, it's a good hedge in case this thing takes off to the upside. Or if news comes out, right? Maybe Trump decides that, hey, you know what? We're going to end major escalations. We're going to pull back 80% of the thing. We've did what we came to do, and we're leaving now. I would imagine the market will probably react pretty positively to that, but we'll see. I mean, it's hard to tell. Market reacts really weird sometimes. It's counterintuitive at times, but um, as the last bullet point says, they're scaling out. Move stops to break even. Once you get in a position where you've banked some profit, then you will usually will start to breathe easy, right? If you say you go in and buy 10 contracts and you just take say a 20%, 30% gain on 2 or 3 contracts. If you haven't done that before, go do it. And then watch what happens. Pay attention to your emotions when that 2 contract order gets filled. And now you've got 8. You bought something at 4 and a quarter and you throw an order out for $6 and it hits. Yeah, you made $1.75 on 2 contracts. Okay. You not only reduced 20% of your risk, but you banked a little bit of profit. So you actually probably reduced 22, 25, 27%. But just pay attention to how you feel when that 2 contracts hits. And you'll be like, wow, you'll be a lot more relaxed about the 8. And now you're like, okay, I'm more comfortable holding on to these and giving it the time to wiggle because a lot of times what happens, it'll move in your favor. You get up 20, 30%, like, woo, and you want to take profit, right? Because you don't want to leave it there in case it turns around. Because you've had that experience probably where you get up a little bit and then it turns around and you end up losing. But what you'll notice is that you will, now I can relax about the other 8 contracts. If it keeps running in my favor, awesome. I'm still making money. But if it backs up against you and stops you out, guess what? You've lost less. The hit wasn't quite as bad. And you're able to breathe easy while you're in the trade, right? I will, Tom. Jeez, holy cow, it's already 9:40. Wow, okay. Hang on a second. Um, yeah, Tom says haven't scaled out. Need more on scaling in. But yeah, let me. I'll show you that in a minute. Um, yeah, Alex, that's what when it comes to discipline, tracking my P&L as far as every single trade, I just that's not something that I really care that much about. As long as my account's growing, that's all I care about. I used to do that honestly, but now I have so many trades going that it's like I mean I'm in like I have 10 or 12 now. I used to keep it to 4 or 5 because that's all I was comfortable managing at the time. But I've gotten to that point, and a lot of it has to do with what you're seeing today is the risk part of it. Is I've gotten to that point where, and especially the scaling thing has gotten me to that point where I can have 10 or 15 or even I think I had 25 positions on a month ago because mainly because of the scaling. And a lot of it is I'm down to one, two, three contracts on a lot of them. They're ones that have moved in my favor, and I've gotten all my initial capital back and then some profit usually, and I leave a little piece of it there. So if it keeps going, I just can give it time now and let it play out. Because you've probably had that experience where you got into a trade and you're like, and it keeps moving. You get out of the trade completely, and 2 weeks later, you go back and look at it. It's like, if I would have stayed in, I would have made double my profits. Well, by scaling out and getting all your profits out, leaving just a little piece there, and if it keeps running, and leave a loose stop on it, and then if it keeps going, great. You're opening the door for a grand slam, right? Instead of just a double or a triple or even a home run. And yeah, you have a lot smaller position there, but if you've already got all your capital back and a profit, even if it goes to zero, you're still okay, right? Net, you're still profiting. Anyway, that's one of the reasons I do it. But um, you know what? I have debated though, Alex, trying to figure out how to create a calculator to, and you know what? I should do this with use an AI tool. I played with Claude. I use Grok mostly now, but um, I know I did play with something like that, a risk reward calculator at one point, just a couple months ago. I was like, it would be nice to create that. Just go to a Claude. I mean, you can use Claude for free. Grok's free too. I mean, you can pay for the advanced one, but um, and they're relatively cheap. But ask it to just tell it, say, I'm trading options with multiple positions. I'm getting in and out in multiple pieces. Can you create a calculator that gives me, you know, an option to add or take away 5 legs or it's just a matter of telling it what you want and letting it kind of do its thing. Um, because yeah, it's hard to do in Excel. I tried years ago to do that, and that's part of the reason I just gave up on it. Like I'm not going to fight this stupid thing and try to figure out how to manage it. I mean, every single trade. Um, Mainly because, like I said, as long as my overall account is growing over time, I'm not concerned about every single little trade. Fear and greed, right? This is the issue. Fear cuts winners short. Greed keeps losers alive too long. Trade the plan, not the emotions. That actually should say, it's just hit my brain. Trade the plan and manage the emotions. You're not going to eliminate emotions. Anytime I hear somebody say trade without emotion, I say run. Run like the wind. It's just not, that's like saying be married without emotion. Don't ever make your wife mad. I mean, it's impossible, right, guys? Sorry, ladies. Oh, that was cold. Holy cow. Brenda says, unless you're dead. That's actually really funny. That was perfect timing, too. Oh, that was beautiful, actually. Hilarious and cold. uh, but yeah. Um, yeah, trade the plan, manage the emotions. But the goal should be, and this is why I'm not, yeah, that is true too. It's true, funny, and cold. It's all the above. See, things can be more than one thing at a time. It's not, except for trade, Tom. um, no, trading's a mindset thing more than anything. Uh, but yeah, a lot of people get stuck in binary thinking, an either or mindset instead of a both and. You can have both and. You can have both profitable trading and you can have calm, cool, collective trading. I mean, it's a good little segue actually, because yeah, I've never been a huge fan, especially when it comes to trading and trying to set financial goals like money goals. And it's not that it's a bad thing because it's not a bad thing to have a target to shoot at. But the thing about trading is it's like any other business, except that it's a little wild. It's more emotional than a traditional business, but it has its ebbs and flows, right? You're going to have months where you make a killing. You're going to have months where you lose money. You're going to have months where you get killed. I mean, most businesses are like that. Most retail businesses make, the vast majority of their annual profits come in 2 months of the year at Christmas time. The rest of the year, it's, you make a little bit, lose a little bit, make a little bit, lose a little bit. And trading is no different. And so setting a financial goal, first of all, if you do that, it's got to be realistic. Understanding what trading is and what it is all about. Because I did that in the beginning. It's like if I can make 20% a month, and it's like 20% a month is possible, but to sustain that month after month after month after month is extraordinarily difficult. And it's probably been done by somebody for a period of time, but doing it historically over a 20-year period, I can't imagine is feasible. But I certainly haven't done it. I don't know anybody that has. So, but doing a double, a triple of your account size over a year's period, yeah, I've done that. I've done a double. I haven't done a triple or quadruple yet, but then again, once you get to a bigger account, it gets harder and harder the bigger the account gets. So, but in my world, instead of setting a financial goal, my goal is to be calm, cool, and collected. To always be in that space where no matter what I'm trading, no matter when I'm trading, how I'm trading, I'm just breathing easy. I can just make a decision and be like, okay, I got this much risk. I'm comfortable with that amount of risk. Let's pull the trigger on it. What am I worried about? Here's my stop. Here's my target. Here's my entry. Here's this. Here's that. Here's how much risk I have. All right, just pull the trigger. And I've gotten to that point. It took me a long time, but I had to really focus on getting to that goal to where it's just a calm, cool, it's just a process, right? You're just like any other business, right? If you have a clothing business and you're, buying clothes that you think are going to fly off the shelves next month, you get all freaked out about it. You're like, oh, you're freaking out. No, you don't. Okay, it's going to cost me $2,000 to buy this collection of clothes and put them on the shelves. And I got labor of this and I got overhead of this. And here's my costs. And if I sell them all, then I'll make triple my money. I'll make 6 grand on that lot of clothes. People that are doing that, buyers for retail stuff, they don't get all emotional and freak out and be like, it's just a process. And they've honed the process down to where this is what we do. This is how we make a profit. It's just what they do. And trading should be the same thing. It should be no different, right? No, you're onto something else. Um, and this is just kind of review here, and then we'll go to that actually. I'm going to show two things, APH, but speaking of framework, I mean, just creating a framework or a process, if you will, whatever you want to call it, doesn't really matter. Again, I'm not worried about the semantics of things. The key is to honing the skill down to a point where you've got the process in place and you have your uh, everything in place to where you can trade from that calm, cool, collected area, right? You find a setup, whatever that is. Obviously I use patterns. If you use fibs like Rob does, that can give you a setup. You're still using patterns, even if you're using fibs. So patterns are critically important, whatever they are, whether it's just a basic pattern or it's a roll reversal, something I love too. Just a basic roll reversal can be beautiful. So you find a setup, right? You find some opportunity that looks good. What's your stop? Then what's your target? Then what's your entry? What's the position size? Do you have risk reward that's favorable? If you're doing non-directional trades, I meant to say this before. I know I said that if you're trading directionally, the risk reward 3 to 1 is there. Non-directional trades have a different risk reward profile, right? If you're doing a covered call, if you're doing spreads, depending on how you do the spreads, you can get a 3 to 1 risk reward on a spread. It's a super aggressive way to do it, and you'll make a killing if it works. But the odds of it working are a lot slimmer than it not working. But that's the beauty of non-directional trading is that you walk into it, especially take a spread, for example, right? If you do a bull put spread, a credit spread, let's say. Debit spreads, you can get 3 to 1 all day long. But a debit spread, say you got a $5 spread, you're getting a $1 credit. Well, that's a 1 to 4 risk reward, right? You have $4 of risk and $1 of potential reward. But the stock doesn't have to move in your direction It can move, it can stay the same, or it can go up if you say a bull put spread, right? A bullish trade. Or even, depending on how far out of the money you go, it can drop a little bit and you're still okay. So you have at least a two-thirds, if not a 70 or 75% chance of that trade working out in your favor anyway, just from a statistical standpoint. Because if it stays flat or it goes up, there's 2 out of 3, right? It goes up, down, and sideways. 2 out of 3 chances of the trade working out for you. That's 66%. And then if you got a little bit of a cushion, if you went out of the money, you bump that up to 70, 75%. So you automatically have the odds in your favor by doing that type of thing. So the risk reward profile is different for that type of trading. But if you're trading directionally, which that's the reason I'm not opposed to credit spreads, but no matter how far the stock goes, you're only going to make a buck on that trade, right? In that example I used. Whereas if you're buying calls or puts, if it moves big, 2x, 3x, 4x is possible, even 12x, right? But number 7 and 8 are good. What's the trader? What do you do if the stock moves against you? Which I know it's kind of a dumb question. You stop out, right? Easier said than done. But what if it is moving in your favor? Because this is actually, excuse me, this is actually more of a quantity for most of us than if it's moved against you. Right? It's not fun stopping out, but if you find that you can't pull the trigger on a stop, if you're just using an alert and you can't get out of it, then use a hard stop. Um, I've been there too. I do sometimes as well. Alex says number 7. I dropped some words not suitable for polite company. Uh, that's funny. Which you might do with number 8 too, actually. Um, Not so much, actually. I guess that wouldn't be. Depends on what it does, right? Because if it moves in your favor, that's actually where there's more emotions come into it when stocks when it's moving for you than when it's moving against you. At least for me, because at this point, at least, because stopping out to me is no big deal. It's like, okay, I'm losing $200 or $1,000 or 2,000, whatever the number is. It's like, okay, and then you move on, right? But if it moves in your favor and you get out too early and you leave a bunch on the table, it's like, now you're cranky. That's when you start using those words. Son of a, I should have stayed in. Especially when it happens quickly, right? You get out, and by the end of the day, it's taken off, and you're like, I could have made another $2,000 if I would have just held till the end of the day. Then you get mad and start using those non-suitable words. So it happens both ways, but it's actually more challenging when the stock moves in your favor because what do you do? And actually, that's where scaling gets handy because when you start peeling it out little by little and leaving some there, so number one, if it does keep moving in your favor, then you're still making profits. But if it moves against you, then you're not giving it all back. And really, going back to that question, which again is the second time, but that's the main thing to ask is, are you comfortable with the risk? You got into a trade, you put 5,000 into the trade, you're at 7,000. You bought 10 contracts at $5, it's now at $7. And some of you in your mind, you're like, I would give me the 2,000 bucks, I'll take it. You get out of the whole trade. But then it keeps going and hits your target of 10. You're like, I could have made 3,000 more. Well, what if instead of taking out all 10, you took out 3? And then you move your stop up to maybe a break even, which actually technically your break even would be even lower. If you look at your net $5,000 out, okay, and you sell 3 contracts, that's 2,100. Let's call it 2,000. So you recapture 2,000. So now you've got 7 contracts, and from your initial risk is actually 3,000, which divided by 7 contracts is what? I don't know, 425, something like that. So if you go from your initial $5 purchase price and you sell 3 contracts for $1 each, you're dropping your cost basis on those other ones by 50, 70, 80 cents. So if you're looking at it from where's my net profit going to be, you reduce your risk in taking a net profit because now you've got a cost of not $5, but just say $4 to keep the math easy, and the option's trading at 7. It's got to drop 3 full dollars before you go to a net losing position. You see where mentally it completely changes things. Because even when you take just a small chunk off the table, you're reducing the chances of a net loss by quite a bit. Good timing, Tom. Um, when's the best time to set a trailing stop? Um, Depends. I'll give you a lawyer answer, which I know most of us can't stand lawyers, even though there's probably one or two in the room. But it it really does depend. What's the ultimate goal of the trade? How volatile is it? How big of a trailing stop do you do? There's so many variables there. It's hard to give you a static answer to it because there's so many pieces to it. Um, and again, it depends on the instrument. In fact, there we go. I don't know if you heard that little ding. That was a stop hitting. I have a trailing stop. I've been playing with futures for a while, and they're extremely volatile. So I have put a trailing stop on those, uh, and it hits right from the get go, just because they're so volatile and it's so crazy that I'm not going to leave that much risk out there to do that. So with regard to say a futures trade, I have a trailing stop right out of the gates. It's automated. It once I enter the trade, it's automatically put there. I've actually got three, depending on I've got different sizes, right? I'll do, maybe one contract sometimes, and I have a trailer on that, 3 and 5 contract trades, and I'll have trailers on each of them. One really tight, one a little bit looser, and then a super loose one, hoping to catch a big move. So it really depends. If you're trading a stock, depends on the volatility of the stock too. But as far as what's the best time, I would say right out of the gates, or you start with a static stop and then change it to a trailing stop. But that would also vary depending on what you're trading and where it's at. So they said there's no really hard and fast answer for that. It's all a lot of it's just kind of feel of where do you think it might go. So, but getting back to okay, let's hit so Alex real quick, and then we'll come back. Who asked that question about? Oh, Tom, as far as scaling in. Um, so yeah, we are. Well, I put these on, and this is the spiders, basically the same as the SPX. Well, look at the numbers though. You say a 20% pullback from last year's low, 4,800 to a high of 7,800. Oh, are you talking about a 20% move from the? You talking about that range? So from 4,800 to 7,000, that's 2,200, 440. So we've 65, 60. Okay, now I see your math. Yeah, at first I was like, I wasn't really paying that. Um, yeah, that's funny actually. So you're taking the range from the high to there and doing 20% of that distance, which makes sense. Um, yeah, which you can see at the chart there. You've got the two times we dropped off last year, really heavy, those 1 days, they bounced right there at the 60, 650, 6,500, same thing. So yeah, there's a major support right here in this area. Hence the reason that I just hedged my bearish positions. So that if it bounces here, which it probably could, and obviously it could, but I think it might. Um, the only thing I was like, yeah, you know what? It's a Friday with a war going on, lots of chaos. I don't imagine the Bulls are going to come in and start buying this afternoon or sometime today. And I would imagine that anybody that worries about weekend news, when you get in situations like this, the weekend, a lot of times people don't want to hold over the weekend, especially short-term traders, because God knows what could happen over the week. You got 2 full days where the market's closed, you can't do anything. I don't want to have my money at risk. So a lot of people will just bail out for the weekend, which makes sense. I mean, I wouldn't necessarily want to hold bullish positions over the weekend either. So, but yeah, I drew these 10 and 20% targets from the highs, which is what yeah, it depends on who you're talking to. Some people will use the math that you're using, which obviously works because there is a support level there you can see. But as far as 10% and 20% from the highs, there's the 10% moves about 625, 20% moves down about 550. 646 target. Okay, I'm not sure where you get 646, but I mean I mean 650, 646, that's pretty close. If you haven't ever listened to Steve Nissen, I think it was him that said, or maybe it was John Murphy, said you want to draw your support and resistance with a crayon and not a pencil. And if you get down to the nitty gritty, every little penny, then yeah, you're going to have issues. I'm guessing probably, whoops. Yeah, there's a weekly. I mean, 646, 650, pretty much the same as far as I'm concerned. So, but let me get to, yeah, it depends on who you talk to, Alex. There's a million different ways to do it, and there's not really a right or wrong way to do it. There's really not. Some people say you have to do it like this, you have to do it like that, do this, do that, do that. You know what they say about opinions? And it is probably more true in this arena than any other one on the planet. Because everybody wants to believe that their way is the right way. And I don't pitch, I just, you know what? Figure out what works for you. I don't say trade my way, trade this way, trade that way. I mean, there's things that have benefited me and the things that they've done for my own personal trading. And that's what I share. It's like, this is what, in fact, I want to get to that because I think it was Tom that asked, I think, about scaling in. I'll show you a, no, yeah, that's fine. Here's one of them. So this is one reason I love to scale in. Um, I mean, scaling out is obvious, right? And it's easy to see. It's easy to understand emotionally why taking money off the table can be good. Um, but scaling in is harder. And it was a challenge for me too. And I realized, but then once I did it, and this is why I tell people, do it. Just try it. Just go do one contract with real money to see what it, just to see. Take this. I mean, here's APH, right? So beautiful. Whoops. It's actually a really nice looking head and shoulders. And it's sitting right on the neckline right now. But last week, we've got the head and shoulders. And generally speaking, you're not going to enter a trade like this pattern until it breaks the neckline. Hence the reason I have that trading plan, the entry point down below the neckline. So if it breaks, then that's my entry is 124.77. My target's down here at the measure move, right? You got 38 points, the 3-to-1 target. I kind of dropped the 3-to-1, 4-to-1 in there. Again, it's kind of a guessing game. There's no rhyme or reason to it. And if it's moving in my favor, and this is the beauty, I don't have to worry too much about hitting it exactly because when you're scaling, it doesn't really matter. If you've gotten 80% of the trade off the table, you've got all your initial capital back and a profit, and you leave 20% of the trade there and see if it, over the next 2 weeks or a month can go even further and you make more and you put a loose stop on it, you stop worrying about hitting an exact target. It's like, okay, just go. I don't care now. I got all my money back. I put 5 grand in. I got 7 grand back. I still have 3 contracts there. Cool. Run. Give me another 3 or 4 grand or 5 grand. You can just breathe easy, right? So a couple weeks ago, this showed up on the radar, and then we've got this little kind of triple top showing up there. So I can't remember what day it was, but one of these days up around the triple top, I'm like, you know what? I'm just going to nibble on this thing. I picked up, I think, just 2 or 3 contracts. I'm like, it's premature, it's early, but with this big drop, we've got some momentum. It's chopping around here, and I think it's probably going to fall from here. So I picked up just 2 or 3 contracts at, let me look. I can't remember. I think they were $4 or 4.25. Come on, this thing's slowing me down. I don't like when it slows me down. 390. So I picked up, I think I don't remember if I did 2 or 3. Um, because I just have two there now, but I'm waiting to add to it. Um, so I picked it up somewhere right up there near the top at 390. And I threw an order out for $6, I think it was, for just one or two of them. And yesterday it triggered. It gapped down enough. It triggered that $6 and it sold off part of it. I still had just one contract sitting there. And I'm waiting to see if it breaks down and breaks the neckline. But now I mean, I paid 390. I sold it for, I think it was just one, whatever it was, doesn't matter, for $6. So I've got $2 of profit basically on one contract already. And then this morning when it gapped up a little bit, what did it get? That is weird. No, it gapped down a little bit. That doesn't look right. I'm looking at the daily chart. It gapped down a little bit, but not that much, I don't think. Let's see. We closed yesterday at 130.63 and we gapped down to I don't know why this made it 130. Yeah, that gap looks a little too big. But whatever it is, I mean, it triggered down here at $6. And this morning at some point, I reloaded it at 475. So I've only got a couple of contracts there. But if it breaks down, yeah, I know, but I'm looking at the opening. I thought it gapped up a little bit, but it did gap down a little bit. It's really, really small on the intraday chart. It looks like a big gap here, but I think it's about right. So I was just looking at the opening because I reloaded that one. So in other words, I've got just a little tiny position here, and I had a stop. I know I had a line up here somewhere. I think it was right above that. So it's like I've only got two contracts here. If it breaks up, it's only going to cost me a couple $100. It's not a whole lot of risk. But if it breaks down, I bank some profit. And if it continues to fall, then I still have that one contract. I can add to it if it breaks down and hits my entry. But now I've already banked a couple $100 on one contract. I reloaded the position this morning. I sold it yesterday for 6. I bought it this morning for 475. So now I've got just a couple little contracts there. Again, it's not a lot of risk. It's only $1,000, but if it comes down here, I might pick up 5 or 10 or 20. We'll see what the action looks like. But I can add back to it and get into here. And I'm already ahead. The options might be if I buy the same ones. Sometimes I'll go buy different options and leave those, the small, original small position. And maybe things change. It's like, I think longer term, this is going to go bigger. So I'll buy more time. But if I add to it, I mean, they might cost me $6 down here at 125. But then I've got a couple contracts that I've got it basically four and a quarter, 450, my cost basis. So even if I load up on, say, 10 of them at $6 here, then my cost basis will still be probably 570, 560, 570 on the whole lot. So I'm already ahead of the game a little bit. It's 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 hard to really grasp mentally until you do it. Because it was for me. Scaling out, easy. Scaling in was a little more challenging. Because the thing that will frustrate you is you get in here and then you get down here, you're like, oh, I should have just bought all 10 of them right there. Well, yeah, but you didn't know it was going to make this move. And when you don't know, I mean, and we never know with certainty. But the beauty is that I can now add to this position, even though I've only got two tiny contracts, but it's still going to keep my cost basis lower than when I add to it. Now, hopefully that makes sense. And if it doesn't, like I said, go do it. And what you will see the difference because on two contracts, I didn't care. I'm like, I'm calm about it. Even when it busted up here, because I know I had a stop, I had a line up here that I took off. But I didn't get out of it because I'm going to wait for the rest of the day. I'm going to wait for the close because I don't have a lot of risk. It goes back to that calm, cool, collected space. I was calm, cool, and collected about it because I only had a couple of contracts there and it wasn't going to cost me much. If it did stay up there in that 145, even if it ran to 150, it wouldn't have cost that much. So I was calm, cool, and collected and allowed me to hang through that day. And by the end of the day, it closed lower. I mean, it moved 10 points that one day, especially on volatile stocks like this. It's a super cool tool to keep you in that calm, cool, collected space. So, like I say, you just have to go do it, and you'll see what I mean once you start to do it. And once you start to do it, both scaling in and scaling out, once you start to do it, you won't stop. It's like a drug. It really is. I mean, here's another example, UAL. And this one was even better because this one I entered the trade. I don't remember where I got in, but you see all the choppiness here, right? I did that. What I just explained on APH, I did that 3 or 4 times here while this thing chopped around. And the beauty was, I can't remember where I got in exactly, but I know I got out of part of the position here. And then it popped up. I reloaded it. I got out of more here. And then this day that it moved big to the upside and it actually hit the stop, I already banked a little bit of profit on the whole thing. I'd been in and out at least a couple of times. And I didn't have a big position. And I was like, this move is just crazy. What's going on? I'll wait till the end of the day. And by the end of the day, it stayed up there. So I was like, I don't like this. But even though it went past my stop, I still wasn't in a losing position. I was about break even, I think. So you know what? I can hang on. So it allows you to, even though you should stop out, I'm not saying to break your rules, but if you put yourself in a position where you're not concerned about taking it out now because you're not in a losing position on a net basis, right? Then okay, you could be a little lax on your stops. And in this case, it paid off because I sat and waited because I was essentially break even. The next couple days, it jumped around, and then that bearish engulfing pattern came in. I went, you know what? That's good. The next morning, it gapped up, and I went, that engulfing pattern's a pretty big clue. We're at the previous high, so that's a beginning of a double top. You got a bearish engulfing pattern, which is super bearish. It gaps up the next morning, and somewhere I added to the position there, and it was actually less than what I paid down here for it. So I picked up another little bit to it, and then it tanked the rest of the day. I think it may have actually triggered. I threw an order out at like 23rd. I think it triggered there. And then finally, this thing cracked down. And I think I was paying, I mean, between $3 and $5 for the options here. And then when it busted down, that's about when the war started. When it busted down, when oil went, I mean, I think I got 3x on the last little bit. I started peeling it out. I think I got one at a double. And the last one I got out somewhere like a triple. So scaling in and out in the chop like this padded my profits in a big way, and I wasn't freaking out. So it allowed me to stay again in that calm, cool, collected space, even though the stock is wild and crazy. It's chopping all over. It's hit my stop, but I'm okay because I'm still in a net profit position, or I'm about break even, or my loss won't be that big if it does continue to run against me. That's the beauty of scaling. And if you could get in and make a little bit here, a little bit there, and keep a position for when it does move or if it moves, that's exactly what this one played out beautifully. Now they don't all work out like this, but obviously you're going to have some that go against you and stop out. But again, if you're just nibbling on it, taking a little bit here, a little bit there, but keep a position there because you say longer term I'm bearish or longer term I'm bullish. So let me take a little bit inside the chop on the slop, bank a little bit of profit, pad a little bit of the risk. Boom. Calm, cool, and collected. So anyway, um, well, it's hard for me to do that on the spiders because I didn't actually do it. Those were those are two trades I actually UAL I'm out of. APH I'm waiting for it to break. Actually, I hope it breaks to the downside. It's already there's the beauty is I'm already up a little bit on the second part. I'm still healthy profitable on the first contract, and the second contract they just added today is already up a little bit. Um, so if it keeps going, then I'm golden. And then if it hits that entry point, I'll add to it. The weird thing is now I kind of want this market to pop because I spent a little bit on that hedging position. I kind of want it to head north, but at the same time I don't. At the same time I want it to tank. So it's better for me if it tanks actually. But it's nice to have a hedge there just in case news happens over the weekend that the market likes, and then I won't get beat up quite as bad if it does take off. So did that kind of clarify, Tom? I hope. I think it was you that asked the question, right? So yeah, good. There's the beauty, Alex. I know this is what alternate reality are we in? You want the market to bounce, and Rob wants it to go down. I want it to go down, actually. Um, no, I literally because I mean, just looking at that chart you're looking at right now. I'm looking at the market going, we're 652. Well, and here's the other big thing. Here's the reason I don't think we're going to bounce is there's the 50-day moving average. And um, the Dow, the SPX, and the NASDAQ all broke it yesterday. And the continuation today is a pretty solid indication that we're going to probably continue south. At the same time, when we get bearish moves like this, they will, like I said earlier, they will bounce and they will usually bounce very violently because you've got the buy the dippers when they come in to buy and the people that are shorting, which generally speaking, those that trade the downside of the market are generally speaking considered a little more sophisticated because I wouldn't say it's riskier, but it takes a little more knowledge and a little more expertise to do that. A lot of people don't even know you can. I was just talking to a guy last week. He's like, "What? You can do that? Is that legal?" Yeah, it is. It's beautiful too. Uh, but um, I'm heavily loaded up on the bearish side. And so I literally, right before we started, that's why I was a couple of minutes late. I was trying to place this order and there was some stupid error. I tried to do it in a different account. And I'm like, no, that's not the account. I don't know why it doesn't. I thought I had it set up to default to this one account, but I tried to do it in this other account. It's like, no, I don't want it in that. In that account doesn't have, um, I don't remember what it was. It was some stupid error. Says you can't do this in that account. I'm like, whatever. It's not the account I wanted anyway. So um, I mainly just picked up a really small position, a weekly option, just as a hedge. So if this thing does bounce, or if over the weekend news comes out and this thing gaps up to 670, 680 Monday because of some kind of news, then my bearish positions will they'll be losing big if it bounces up. But I just pick up a small position, like, okay, if it goes away, if this market continues to tank, I'm going to overcome that small amount anyway. If it bolts to the upside, then I have at least some protection and I'll make money on that option while I'm losing on the other stuff. So it's just a way to hedge. So, and there's the weird dichotomy that we get into emotionally is that now that I have this hedge, I want to make a profit on the hedge. I don't want it to expire because I just bought a weekly option, right? Between now and next Friday. Like, I don't want it to expire worthless, but at the same time I do. Because if it expires worthless, that means the market continue to fall, which means all my bearish positions continue to pay off, which is what I ultimately want. But it would be really cool if this thing would bounce for a week, and then I could take a profit on that hedge position, and then it turns over tanks. But none of us know if that's going to happen or not, right? I don't. So, um, yeah, and part of the reason is, well, back here actually, right here. See, this is partly off of memory. That day right there, I was loaded up on bearish positions, and I had gotten into them over the month, and this day was a big day. I mean, it was the morning chart didn't start off good; it gapped up, and then by the end of the day, it was like my bearish positions were up a lot. I'm like, ooh! And guess what? I didn't do. I didn't hedge. I didn't do anything with it because I thought it was going to keep going. It looked like it was going to, and it bounced big time here. And had I bought a weekly option like I just did today, and it bounced like this, I would have killed it on that one. Instead, I just held on. I didn't stop out either because the positions I had didn't, the stops didn't hit. But if I would have bought a call on the overall market itself, on the spiders or the Russell, either one, it would have paid off big time. So part of this is memory and like not necessarily fear, but going, that was a learning experience. Like if I would have just done this, I would have killed it on that option. And then my other positions would have been okay. So I did not talk about quad riching, Michelle. I don't, for the most part, I don't really pay that close attention to that a whole lot. Just, I mean, my style of trading doesn't require it. It's not one of those things that has an impact on what I do. So I don't pay super close attention to it. So, I mean, if it affects your style of trading and what you're doing, then yeah, definitely keep an eye on it. So there's a million different ways to do this to run your trading business and do it. And there's no, like I said, there's no right or wrong way to do it. Um, it's a matter of figuring out, what your risk tolerance is and how much you can handle and how to get yourself to that calm, cool, collected place. What strategies to employ, what techniques to use, and how to get yourself to where you can trade and just make good decisions. Because when you're calm, cool, and collected, you'll make good decisions. It's when you're freaking out and your emotions are raging that you make dumb decisions. And thankfully, I don't do that too often anymore. But I mean, I still do. We all succumb to it at some point. The question is get to a point where you do that on a rarer and rarer occasion. So the goal should be to get to that calm, cool, collected place because that's when your trading will change. And you'll start to be more consistent. You'll have a more steady growth. So anyway, I'm way over, way, way over now. So good questions, fun comments today, which usually we're having a lot of fun in here, but today was a little more fun than normal. So I appreciate it. It's a lot more fun when there's a lot of interaction. So sometimes you get crowds that just stare at you. They're like, ah. So it's fun to have the back and forth and jabbing each other a little bit. So life's too short to be serious all the time. So and trading's stressful and emotional enough. It's like, but that's the beauty. It's not for me. It's not even stressful anymore. It's not. Some people freak out and they're like, it's all stressful, and it's like, and it shouldn't be. It should be fun. You should be able to sit and just make decisions and go, okay, here's what I'm doing. And hedging, the reason I hedged today is, so that I can become cool collected. That was the purpose of mine because we're at a major support level there, and the odds are decent. If it doesn't bounce today, at some point next week, it's going to bounce. And the question is, how far does it bounce and how big's the bounce? And now I can go into the weekend like, okay, I'm loaded up on the downside. If it keeps falling, awesome. I'll easily cover that little tiny bit I put into the hedging position. But if it does bounce, then I've got a hedge there, so it will at least um, soften the blow, if you will. I won't lose as much. And if it really took off to the upside big, well, and that's what happened back here in November. I would have actually, I think the options would have been like 60 cents or something, and I would have been able to cash them out for like $10. And I'm like, so I actually think we're going to break this 650 level. I think we're coming down to this 630, 610 to 630 range. That's my honest opinion about what the market's going to do. I don't think it's going to hold this level, mainly because we're below the 200-day moving average. A lot of people are going to start selling. And I think we are in for a sizable pullback. The question is how far and how fast does it go? So, but we'll see. I mean, there's so many variables that can change things. It's always hard to say. But the bigger picture is starting to look more and more bearish. You got private credit is cracking, even though that's usually people that have lots of money, so it's not like it's hurting the average Joe, but it will spill into the banking sector. Um, and it will have an effect. The question is how big is it? So, oh yeah, and what Deb, it will help in day trading too. I don't care whatever style, whatever time frame you're trading on, doesn't really matter. That's actually where I started doing it back in 2001 in a decent way. I would buy 1,000 shares of a stock and immediately sell off 400 of them at like a nickel. I think it was a nickel or a dime because I ran the math on it. It's like, you got a 20-cent stop. If you unload 400 shares at a nickel, not only you're making $20, which again is not huge, but then and then you have a trailing stop on it. You reduce your risk from $200 to like 75, I think it was. And it only took a nickel move or a dime move. I can't remember what it was, but you look at it that way and you go, I go from $200 and it usually would hit within a minute or two. I mean, it doesn't take long for stocks to move that much, right? You run the math on it, I go, okay, I had $200 of risk and I literally within a minute or two, I'm down to $75 of risk. I cut my risk by 60, 70%, just like that. And now I can relax and let the rest of the position play out. So anyway, enough about that. Sorry, Alyssa. I'm way beyond I'm supposed to be. So anyway. All right. Hopefully y'all got some nuggets out of that. And we'll see you on the next go around whenever we're here on a Friday. So you have a great weekend too. So thank you. You'll have a good one. God bless. Bye-bye.